This is Street Signals, a weekly conversation about markets and macro, brought to you by State Street Markets. I'm your host, Tim Graff, head of Macro Strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week. It's become a tradition to do an episode this time of every year with MARVIN LOH, our U.S. rates-focused strategist based in Boston, where he and I chat about the upcoming Jackson Hole Symposium that's hosted by the Kansas City Fed, typically around this time of year in late August. For the last 5 years, Jackson Hole has been an occasion that's used to answer questions about potential shifts in policy. It's also where any changes to the Fed's operating framework are first flagged. But this year, it might be a little bit different. Now, don't get me wrong, markets will have a lot of questions about what the Fed is thinking, especially after some of the muddy messaging from their meeting last month. But the Kevin Warsh Fed already has a lot of task forces that are looking into the Fed's operating model, and we probably shouldn't expect too much output from them so soon. Also, there seems to be a pretty healthy debate going on about the near-term path of policy, but it's really hard to see that resolving in the next couple of meetings. So it might be reasonable to expect fewer big headlines from this year's event. But that doesn't mean there's nothing to think or talk about. That is just not a thing when it comes to Marv and I having a conversation.
Timothy.
Hey, how are you?
Good. What about yourself?
I'm good. Well, Marv, I think this is year 3. We have done a Jackson Hole preview podcast, and I guess we'll do a little bit about that. But we also are going to do a lot more about the Fed and what you're thinking right now. But we have the event in front of us. Well, a couple of weeks away, I guess. It's still nearly 3 weeks away. Is this a pivotal Jackson Hole? Do we have those anymore? Is the Warsh Fed going to use this in the same way that the Powell Fed did?
First off, how is it that it's been a year since we talked about this last?
Well, Jackson Hole is every year, Marv, so it makes sense.
But where did the year go, I guess is what I'm saying.
Yeah, fair, yes.
You know what? It will not be as pivotal from a near-term policy perspective as we've gotten used to. We're not going to get a signal as we did in the last 2 years from Powell that they were, ready to either start or restart, a cutting cycle, really very much within that lack of forward guidance approach that the new Warsh Fed, and it seems like others, are taking to heart these days. It will, however, be important to understand a bit more about the new chairman, because I think, what we've had in the first couple of meetings is a little bit of confusion about how to interpret him.
Yeah, so what do you think? I mean, and it's a good point because he hasn't really offered much. And
that's being kind.
Yeah. Well, obviously some of it is by design because, as you say, he clearly wants to dial down the volume of, and by volume, I don't mean the noise level, but the actual amount of Fed communication. And it seems like he's trying to do that, but you could also be less generous and interpret it as he doesn't really have an idea. But then you could be generous and say, well, who does have a good idea of where policy settings should be right now? So I'm curious what you think would be top of mind for him to get across.
For sure. And we've gone through, at this point, 3 very talkative, vocal heads of the FOMC with regard to how to approach policy in the public sphere. So this is, in a lot of ways, new to us. Each one of those chairs, whether we're talking about Bernanke, whether we're talking about Yellen, whether we're talking about Powell, they had their missteps early on. It took a while for us to understand how they approach things, and it took them some time to figure out how to communicate with the public, with the market. So I'm going to chalk up a bit of this in terms of learning on both sides of it. What I do think, however, is that in Warsh's attempt to be different, it's created a bit of confusion in what is fair game for us to ask and what is completely off bounds. And not necessarily off bounds, but within the realm that he's definitely not going to answer. So he's not going to answer anything that pre-commits the committee to what's going to happen at the next meeting. And that's not necessarily a bad thing. We should come to our own conclusions without the FOMC telling us what they're going to do. What he, I think, failed at, this is probably my biggest criticism, is that we really don't understand the reaction function. We don't know what's driving the Fed in terms of how it might look at different policy regimes. And I think that maybe when he really tried to keep everything close to the vest, he kept that close to the vest to a point where you saw the market reaction, which was probably not what he had hoped for. Maybe he's not that upset about it. But having said that, it offered undue volatility into a market which he has said, I want to get information from the market. So it became harder for him to interpret what investors were thinking because he made everything excessively opaque in my mind.
I think that's fair, certainly, from in terms of the market reaction to it and him wanting to take from it. Absolutely. Reaction functions, and particularly how they differ from forward guidance. I want to talk a little bit more about that. I could push back and say a reaction function is within the Fed's mandate, right? Like full employment, 2% inflation. Our reaction function is to make sure we get to that, and if we're not there, we react, because that is simply the mandate. It's the Fed doing its job. So what
Yeah.
more beyond that, without going down the road of forward guidance, which he's clearly, as you say, trying to get away from?
He's throwing everything in the kitchen sink with regard to how U.S. monetary policy is going to be approached. The famous task force, if you will, pretty much touch on the most important aspects of how the Fed is going to look at the economy and how policy is going to be calibrated around how the Fed looks at the economy. So to a certain degree, it's because he doesn't have the information, because the task force, for the most part, are just getting going. And I think one of the things that he'll be able to offer is what some of the original or what some of the earlier findings within these task force are starting to uncover. But understanding what he's going to try to get out of it and how that's going to make its way into the policy toolkit, if you will, is something that we're lacking as investors at this point.
Yeah. Okay. I get you. That makes sense. That makes sense to me. You mentioned this earlier, potentially other central banks following his lead. And, on forward guidance specifically, that was quite clear from the Sintra conference that the ECB hosts in the summer. And Lagarde kind of sounded like that a little bit, like she was leaning in that direction. Is this something we should expect? And it brings up the broader question about forward guidance. Would we really actually miss it once it's gone, if it's gone?
As the Fed goes, so goes all the other central banks, right? There's a reason that all of these meetings happen around the same time, with some of them the exact day after the FOMC. That's the importance of the Fed. I think they set a standard in a lot of ways to how central banking is approached around the world, best practices. And quite frankly, I think a lot of the central bankers are happy to not be tied and asked incessantly what they're going to do next, because economics is a dismal science. It's hard, it's volatile, and it should be something that gets incorporated into thought process, on a day-to-day basis. And when you kind of have this forward guidance approach, you don't have that flexibility, and that's bad. Ultimately, that's bad for us as investors, and it's bad for each one of the economies that it affects. It's also something that might not necessarily be necessary, given that we're not going to be talking about the zero lower bound probably for a while, and hopefully never again, quite frankly. Forward guidance came about because we didn't have any more flexibility when it came to the actual rate in terms of driving either the shape of the curve or the degree of investment out there. You needed to get investors comfortable that if we were going to invest in the long term, when rates were near zero, you weren't going to do a head fake on us, because we won't accept that risk unless we're comfortable with it. That's a world that, for better or for worse, is behind us. Creating an environment where the entire curve can adjust to data is actually a positive. So I don't think we're going to miss it once we kind of understand what the bigger metrics are around the reaction function itself.
Do you think then, as part of this change in communication strategy, and I do want to talk about the communication strategy task force in a moment and come back to the broader aims of the task forces, how effective they will be, et cetera. But I was thinking about this earlier today, and I mentioned this in a piece. We've gone from the Fed communication strategy basically being a statement, at the beginning of your and my career. And in fact, I think maybe even at the beginning, well, I'm not going to try and date you here, but the Fed didn't even used to release they used to not even release a statement. The market had to kind of figure it out based on what the Fed desk was doing, based on what their decision is. I don't know if that dates you or not. I apologize if it does, if you remember that. But
I do remember it well, unfortunately.
Okay. Okay. Well, then let's probably assume you won't have to deal with questions of zero lower bound anytime soon. Then
I
in the
think
rest
that's
of your
safe to say.
career.
I think that's safe to say
No.
also. Thank you, Tim.
Anyway, I've gotten off track trying to subtly dance around our respective ages. But we've gone from that to some weeks I come in on a Monday and I count the number of Fed appearances, and sometimes it's like 15 of them, and just
Yeah,
clear over communication
yeah.
is, I mean, he's the Fed chair, so presumably he has the power to guide this. But should we expect that to go down significantly in terms of just the number of communications that we get from various members? Is that going to happen pretty much immediately?
Yeah, I mean, and it already has. I think that we over here on the Boston desk have kind of looked at the number of Fed speeches that have been out there, and at the board level, it's gone down to near zero. Every now and then you'll get Warsh speaking somewhere, or you get another one of the Fed governors talking about the state of the banking system. At the regional level, presumably Washington certainly has a little bit of leverage, but not necessarily the same degree of leverage as Warsh would have in the
Right.
immediate FOMC colleagues that he has. That is still somewhat robust. Certainly a bit of dissent coming from the regional side of things, and they're out there talking about why they think that tightening is appropriate at this point. But I think overall, kind of like as this new Fed settles and maybe once policy becomes less two-way, if you will, from an opinions perspective, we will hear less from the FOMC. One other thing that I've been thinking about on this
Yeah.
front, however, is that, like you said, we used to have a sense of what the Fed's reaction function is and what the Fed was doing by looking at the funds market. Ultimately, like there was a period. This was definitely before you and I. There was a period we didn't even know when the Fed met. We just
Yeah.
saw like what Fed funds was doing, and oh my goodness, they must have met. There used to be stories of people watching how many people went into the Eccles building, and if
Hmm.
enough senior Fed people were going to the Eccles building, oh, they must be having a meeting. Let's look at the funds market. So the challenge with that, if is that the funds market is irrelevant at this point in terms of establishing policy. It's still the main way that the Fed communicates what it thinks financial conditions should be, but you can't influence interest rates through the funds market anymore. So you do need a modified approach to communication, because just saying you're going to let the market go on its own and will influence it via kind of the short end of the market is something that just doesn't work in an ample post QE world that we find ourselves in. And if we've heard anything from Warsh, it's that the balance sheet part of the process is going to be this slow, very deeply communicated change, because it's so much harder to really influence the short end through the balance sheet relative to a lot of the other things, a lot of the other regimes that we're talking about.
So that brings up a question about the task forces. And we've talked about one of them is communications, which it's pretty
Huh?
clear, as you say, already having an impact. You see it in the Fed statement alone. It's gone from, this very long document to a couple of paragraphs that
Hmm.
basically tell you what you know and what they've done. But then there's a balance sheet policy task force, one on data, one on productivity and jobs, and then one on the inflation frameworks the Fed uses to understand inflation. And all of those four can have a significant impact on policy. Which one of them do you see as the greatest degree of influence in the future? I mean, some of these are going to be immovable objects, I suspect, but which ones are more malleable in terms of the way the Fed changes how it thinks?
Yeah, you mentioned that to me last week, and it really caused me to think through a lot of where they can have an impact, or whether ultimately the correct answer is going to come out of it. And things like data, things like the inflation framework, certainly they're important, but the data and the market's interpretation of what's important around the data is going to define whether or not they're going down the correct route or incorrect route in my mind. If you create an inflation framework that's just wrong, as investors, we're not going to stand by it, and we're going to make long end yields go higher, and we're going to really wonder about credibility, and that will be the right answer. And in a lot of ways, that's what Warsh has been saying in terms of a signal coming from the market. So maybe going off the page a little bit, I think it's the balance sheet that
Right.
potentially is the most important, because that's where the Fed has a lot of leverage in terms of how to approach the optimal size of the balance sheet. But that is so important to just valuations and liquidity and how this very complex, not only US financial market, but global financial market works. So changes to that have a lot of implications and ramifications in my mind.
Is balance sheet reform possible in a world that isn't also accompanied by reforms to the banking system more broadly, as in like a reform to Basel III, which risk weights central bank reserves at zero? So it incentivizes holding them. How do you get away from that world without broader reform across the globe?
For sure, it's hard. It's even harder when we talk about a world where the amount of government debt, Treasury certainly first and foremost, but
Yeah.
just government debt, period, is significantly higher than what it was before the pandemic and unlikely to go down for a number of reasons, whether it's weaponization from a political side of things or the fact that we've got more fractured regional economies rather than kind of globalization. All of that is no longer supportive of a more reasonable approach to the amount of debt that we have globally. So yes, banking regulation is definitely part of that. I do think that there are, technological advances that might possibly help the amount of reserves that you need within the system, particularly if we talk about tokenization around money funds, tokenization around repo. That potentially could free up some of the reserves that banks feel they need. But ultimately, it does come back to the banking sector, and you can only get to a point where you're comfortable with less reserves in the banking system if that banking system is more effective and efficient in its operations without really negatively impacting the economy. So it's going to be a slow process ultimately. And I do think that if we hear of significant changes around the balance sheet that they want to push through in a short period of time, that's a pretty important tell for me in terms of like volatility and really wondering about whether or not the funding in the financial systems can withstand those types of changes.
Okay. So we've covered the tools off, I think, relatively well, and maybe some of the tactics. And one of the things I wanted to think about was the transmission and step back a bit, especially given we have such modest amounts priced for Fed activity. It was a modest amount of cuts at the beginning of this year. It's now a modest amount of hikes. But the transmission mechanism more broadly, this is where I think one could potentially be forgiving of Warsh in his lack of clarity insofar as, we're talking about potential changes at the margin rather than big C changes in the policy rate. But more broadly, how effective do you think the monetary transmission mechanism is, and how powerful is it for the Fed?
Yeah, I mean, I think the last, 3 to 4 years from, aggressive rate hikes to one where, we were certainly cutting rates even though we didn't see the Phillips curve in action, shows that there is a lack of effectiveness when it comes to policy. And I think that that's really evolved as the duration within this economy has changed as significantly as it has. The long end is incredibly important for financial conditions. The Fed clearly, from a rate setting perspective, is most effective at the short end. They certainly don't have that much in terms of their balance sheet, in terms of short end ownership. So you've got this hodgepodge of things which have come together over the last 10 to 15 years, which I think has made it somewhat ineffective, which is why this inflation environment that we find ourselves in is into the 60th, 62nd, 63rd month at this point of being above target, because it isn't as effective. And, really looking at the business of being a central bank through these task force, really breaking down these walls is appropriate just because of that.
Yeah, so this brings up the rest of the questions I had for you, which is about the current market environment. And I'm glad you brought up inflation as the starting point here, because you have this pattern, not pattern, you have this persistence. And you had until the July meeting a belief that he was coming in as chair with a little bit more of a hawkish tilt than might have been assumed given who he had to interview to get the job with. And we now have had a downside surprise in inflation. We're going to come back to the labor market, but we've had a very weird set of data on the labor market that I want to talk about. But on the inflation side, you've seen inflation now retreat to the Fed's year-end forecast. I mean, where do inflation risks lie for the rest of this year in your?
There's been pretty wholesale adjustments on those inflation expectations. So, certainly relative to what they thought in June, we're at that number at this point. We got a surprisingly weak set of June data, both at the CPI level as well as the PCE level, which I think was probably even a bit more surprising given what some of the producer price information was showing. I'd say that if we were looking at just the year-end forecast, the risk is probably a little bit to the downside, but it had been adjusted by 60 basis points. That's pretty significant. 3.3, 2.7 to 3.3 is pretty significant. So they're at that level. The real question to me is whether or not we're going to get this disinflationary signals that being potentially below that target number by the end of the year, does it give the Fed and really investors enough comfort that the environment is one where we're going to get to 2% within whatever reasonable amount of time? Kind of layer on just really this hyperactive, if you will, borrowing environment, which, drives into R star and at a minimum creates potential crowding out, whether it's corporates crowding out treasuries or treasuries crowding out corporates. That is a legitimate concern and a legitimate reason to want to try to tighten financial conditions. Again, going back to your transmission question, doing it via the funds rate doesn't necessarily impact the long end the way one would expect. And, there's been a lot of talk about whether or not there's a bit of gamesmanship on Warsh's part in trying to get financial conditions a little tighter post that second FOMC meeting with, long yields not necessarily behaving the way one would expect. But, bottom line is that if you think that the supply and demand for capital is out of balance, which is, one of those classic ways of looking at R star, you need to tighten financial conditions. And that would be why you need to keep that tightening bias within the market.
So that's an interesting take. Like I've been relatively forgiving of his strategy, but even that I was struggling to see how one could be forgiving of his response to the fact that the curve was steepening so much, led by the back end. But is that something he can really pursue as a policy objective without getting called out on it? I guess tightening without tightening.
So in terms of one of the things I think he would like to correct is questions about credibility, because really trying to influence the long end is not something that the Fed is very efficient at. They're very good at bringing long yields down, bringing term premiums down when they buy the entire long end of the market. We just have to look at the BOJ and kind of see that. Of course, after decades, you see the challenges that the BOJ has. But raising concerns about credibility just makes it that much harder. Like he would love zero credibility term premium built into the long end, because at least it'll really anchor that inflation expectation. And then we'll get a good signal coming from the long end in terms of the either balance and or demand mismatch of savings versus capital within the market. That's probably the best that he could do. I don't think that there's gamesmanship, quite frankly, not at his second meeting. I think there were, ultimately communication challenges and, I'll say mistakes that maybe he'll use Jackson Hole to try to clean up a little, particularly around that credibility aspect of it. But the market is forgiving, has been forgiving for the moment, but good policy has to come out of the FOMC. You can't avoid that.
Yeah. Well, we've covered one side of the mandate. I wanted to quick finish with the labor market, and I called it kind of a choose your own adventure payroll report that we got last week. Those books we'd read as kids where I'd inevitably get eaten by the ogre before figuring out the right strategy. But the payroll report was really interesting. This is a question I've had for people, maybe not every economist or market watcher that I've had on have I asked this question, but you had a clear sign of evidence that the labor market is getting tighter and that the unemployment rate fell, but payroll growth also fell. And it raises questions of break even and why is the labor force shrinking? And certain reasons we know, certain reasons are less clear. I mean, Should we be thinking about the Fed getting closer to full employment or further away from it?
I would normally lean on the fact that the labor market has been going through this transition period to the point where, someone like Chris Waller said, we're seeing non-farm prints to an extent on the low side is what he was referencing that I never thought I would see in my career. It doesn't necessarily make sense other than we've got structural changes in the job market. So that absolutely is happening. It's something that, we've written about what seems like for years, right? Between demographics and kind of this hawkish approach to immigration, we've got a labor market that is nothing like we've seen in the last 30 years. It's easy to say that. The unemployment rate went down, not necessarily for good reasons because of the kind of change in participation. I'd say that the actual wage gains or lack thereof is probably the potential pushback that I have in saying that everything's clear, don't worry about it. So it's not as worrying as it would have been, let's say 2-3 years ago from a negative print perspective. But also with the lack of wage pressure, it does show that it's not necessarily completely without concern.
Okay, so inflation, you say, maybe starting to show signs of softening and maybe that forecast for year end getting revised down. The labor market may be a little bit softer. Does this then mean we have about 30 basis points priced into effective Fed funds before the end of the year and a total of about 45 of hikes for this mini hiking cycle, if it is a cycle? Is that right? Or is that a little bit overpriced here?
I'm still in the tightening camp, and I do think that even amongst, our colleagues, we're kind of split, if you will, 50-50 on that perspective. But I still am in the tightening camp. I do think financial conditions and really the amount of whether it's hyperscaler debt out there or just, demand for capital, not only US, but globally, is one where financial conditions are potentially getting away from these central bankers. And I think that's why they keep kind of this tightening bias because they do realize that that's something that they can lose control of fairly quickly.
Okay. All right. Very good. Very clear. Marv, as always, we didn't even talk about Jackson Hole that much, but as you say, there's maybe not a lot to expect this time around, but we'll certainly check back. Well, it won't be a year. We always do this a couple times a year, but we'll definitely do it again next year and then one time in between. Marvin Loh, thank you so much. Yeah.
Thanks, Tim.
Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time. Informational purposes only and is not intended to suggest or recommend any transaction, investment, or investment strategy. It does not constitute investment research, nor does it purport to be comprehensive or intended to replace the exercise of an investor's own careful, independent review and judgment regarding any investment decision. This communication and the information herein does not constitute investment, legal, or tax advice and is not a solicitation to buy or sell securities or any financial instrument, nor is it intended to constitute a binding contractual arrangement or commitment by State Street of any kind. The information provided does not take into account any particular investment objectives, strategies, investment horizon, or tax status. The views expressed herein are the views of State Street as of the date specified and are subject to change without notice based on market and other conditions. The information provided herein has been obtained from sources believed to be reliable at the time of publication. Nonetheless, we make no representations or assurances that the information is complete or accurate, and you should not place any reliance on said information. State Street hereby disclaims any warranty and all liability, whether arising in contract, tort, or otherwise, for any losses, liabilities, damages, expenses, or costs, either direct, indirect, consequential, special, or punitive, arising from or in connection with any use of this communication and/or the information herein. State Street or its affiliates may from time to time as principal or agent for its own account or for those of its clients have positions in and/or actively trade in financial instruments or other products identical to or economically related to those discussed in this communication. State Street may have a commercial relationship with issuers of financial instruments or other products discussed in this communication. This communication may contain information deemed to be forward-looking statements. These statements are based on assumptions, analyses, and expectations of State Street in light of its experience and perception of historical trends, current conditions, expected future developments, and other factors it believes appropriate under the circumstances. All information is subject to change without notice. This communication or any portion hereof may not be redistributed without the prior written consent of State Street. Past performance is no guarantee of future results.